So our learning objectives for today, we have 5 different learning objectives. First and foremost is we want to learn how to assemble the right team ahead of an exit or an IPO. We know that a lot of the CFOs or VPs on the line today have big plans with their exits or their IPOs, and so we want to make sure we're hiring the right people and bringing the right group of people in particular into the team there for success. Number 2 is knowing when to hire dedicated roles. So as you expand, you're going to start to specialize. We need to bring in team members on the legal side, HR and FP&A, and Steve is going to give his thoughts on when you should be dedicating people like that. Third, and the item that's closest to the FloQast world here is closing faster and more accurately. This is going to help you meet those due diligence deadlines that are very short during an exit timeframe there. Number 4 is going to be establishing modern and efficient IT systems. We really want to allow accounting to be scalable and be efficient before we really start to add to that team. And so Steve will touch on that as well. And last is knowing when to implement dedicated systems to replace spreadsheets. So a lot of us will scale our company. We'll just use spreadsheets because it's a great piece of software and is very easy to use and cheap. But there does become a time in every company's life cycle when it's time to start moving away from that. And so we'll touch on that as well. And onto the panelists here, I wanted to just introduce myself briefly and then hand most of this time over to Steve. So as Christina mentioned, my name is Mike Whitmire. I'm the co-founder and CEO of an insight company by the name of FloQast. We're out here in Los Angeles. And in FloQast, we build what we call close management software. And our goal is to help companies close the books faster and more accurately. And I am a CPA. I came out of the accounting world. I was with Ernst & Young for about 4 years doing financial statement audits here in LA. And after EY, I wanted to get into the tech world and got really, really lucky and ended up at a pre-IPO company by the name of Cornerstone OnDemand. Today, the ticker is CSOD. We've had a really great run as a business. When I joined, we were about 95 employees. We were a year out from the IPO and had kind of a perfect storm of all the hardest things going on possible within our accounting department. But we weathered that storm. We had a successful IPO 13 months after I joined. During my time, I was there for a total of 3 years, and we scaled the team from 5 to about 50 over those 3 years. And we made quite a few mistakes. I don't think we did things as well as they possibly could have been done. So on this, the kind of play on this panel is Steve's going to talk about how to do things the right way. I'm going to tell a couple stories about how we did things the wrong way to help you avoid some of those pitfalls as you scale. So with that, enough about me. Steve, I want to hand it over to you to let you introduce yourself and Tenable.
Thanks, Mike. And my thanks to Insight for having me today. As Mike mentioned, my name is Steve Vintz. I'm the Chief Financial Officer of Tenable. I've been with Tenable for a little over 4 years now. It's first and only CFO. Tenable recently completed a public offering in July of 2018, so that's last year. Prior to Tenable, I was the CFO of a company called Vocus, which is now Cision. It's a publicly traded SaaS company. Similar to my role at Tenable, I was hired as Vocus's first CFO. I was there for 13 years, 8 of which we were public. And over that time frame, the company raised several rounds of venture capital, went public, and eventually culminated in sale to a private equity firm. Prior to Vocus, I did FP&A and M&A at a publicly traded company. And before that, I worked at EY, similar to Mike. Now, just a little bit about Tenable for those of you who are not familiar. Tenable is the cyber exposure company, which means we help organizations understand and reduce their risk. We serve over 50% of the Fortune 500, over 25% of the Global 2000. And the problem that we're helping solve, companies are increasingly embracing digital technologies, which has created a complex computing environment of cloud, DevOps, mobility, IoT, where everything is connected, all devices, all part of a new modern attack surface. And Tenable has technology and software that discovers all of your assets and devices and tells you where you're exposed, where you're vulnerable, and your level of risk overall.
Thanks for the background there, and I know I'm particularly interested. You joined Tenable back in 2014. have done some awesome things since then. Hyper growth. We have some of the numbers here. So if you want to just walk us through from a numbers perspective what you've seen, and if you have a couple stories along the way, I think that would be interesting.
Sure. Just a little bit of context. I mentioned I've been with the company for about 4 years now. Tenable has been in existence, though, for about 16 years. So the company has a long history of success. It's not a startup. But the company's undergone some pretty significant change over the last 4 years, really all as a preposition to scaling the company and an IPO. Historically, the company was very product-driven, engineering-focused. It's a great core for a technology company, and it was profitable, albeit on more modest growth. But at the time when I started at the end of 2014, there was the backdrop of high-profile data breaches, a lot of market pull, and a solid technology platform. There was recognition that there wasn't a huge commercial capability in the company. So we made a conscious decision at the time when I started to trade points of margin for points of growth, one for market share, and dramatically change the investment profile of the company. This is well after Excel's investment in 2015. It was a Series A round for $50 million. That was 100% secondary shares. And as you'll hear along the way, this growth up until the IPO was all self-financed. But if you take a snapshot of what Tenable looked like in 2014, it had decent scale. It was over 70 million in revenue. It was a perpetual license company, so we're getting 45 cents on the dollar in recurring revenue. We had about 20 sales reps in 4 countries, a little more than 300 employees, and it was the 3 founders that were really making the day-to-day decisions of the company. So with that decision to make investment and run for share and grow the business, the company underwent some pretty extraordinary change. And if you look at, roll forward to today, this is all public information, we have over 150 quota-carrying sales reps. We have 1,300 employees. We have feet on the street in over 20 countries. We transact sales in over 160 countries. We have a fully functioning executive team. And one of the things I do want to mention is this move to the subscription model. We now have nearly 90% recurring revenue. So there was a recognition at the time years ago under a perpetual license company that growing the business and eventually creating long-term leverage may be difficult to do under a perm license model. So we moved to the subscription model. It changed the entire DNA of the company. It's more than just the financing mechanism. It necessitated groups like professional services. We never had that before. We only had online training. We had to go out and create more intimacy with our customers, so we created a customer success teams that focus on renewals, account management, and upsell. So it changed. There was a lot of changes in the company that took place that coincide with the investment. So Tenable, in short, has undergone some pretty significant change over the last 4 years, but we're excited about our next chapter of growth as a public company.
Yeah, it amazes me to hear all those stories and the growth the team has had in 4 years, and particularly, I mean, that transition from 45% of your revenue being recurring up to close to 90% is very impressive in this SaaS world that we live in now. So, thank you for that, Steve. I do want to before we hop into the questions here, take 1 second to give a FloQast overview. So I mentioned this earlier: close management software created by accountants for accountants. We do help teams close the books faster and more accurately. And we focus on the mid-market. We work with companies that have anywhere from 5 accountants up to a couple hundred accountants on their team. We have about just over 500, well, creeping towards 600 customers today. But let's kick back to the content here. So what we're talking about today is really how you assemble an efficient finance department. And when we look at a finance department, there are several different components of it. We've tried to really break it into 4 different components. So first and foremost, and I firmly believe this is the most important component, is the people that you have. It's the type of backgrounds that you've hired and just the overall quality of the people. So Steve's going to touch on some of that. Second is, once you have good people in the door, we need to get good processes in place to really lay that foundation. And those processes are really wide for a CFO. As a CFO, you're dealing with a good chunk of the business. So that's going to include HR processes, month-end close process, your reporting processes, and many more from there. One of the things about an exit is when we come up for an exit or an IPO, all of a sudden documentation is very, very important. That's all going to get audited. It's going to go through some intense due diligence. And so we're going to chat more about how to really save your documentation and make it an easy issue for when the acquisition time does roll around. And at FloQast, we help with the reconciliation process, helps you ensure integrity of the balance sheet and give you that peace of mind that the numbers are correct when you're heading into that due diligence process. So we'll chat a little bit about reconciliations as well. All right, let's kick things off here. So Steve, talking about the team here, what did the finance department look like when you started, and what does it look like today?
Sure. So it looked, a little different years ago. Years ago, the finance department was of more modest size, and it was what you would expect for, a company like Tenable, a private company. We were doing a lot of the basic functions and doing them well, like payables, receivables, billing, licensing, and there was a head of finance there. Keep in mind, I just gave you a little bit of context of some of the change that the company was undergoing over the last 4 years. So with this recognition that we, as a company, wanted to run for growth, create a category leading security company, and build a global sales distribution capability globally, when I started, I knew there would be many changes to the business, but I turned to finance as a function to help enable all that. And I wanted to make sure finance was an enabler, not an inhibitor of growth. And one of the first areas I turned to was FP&A. We didn't have a FP&A function at Tenable when I started. My background is in FP&A. I think FP&A is an important function to help a company successfully grow and scale. So there was none at the time, and we didn't have a formal sales op function. So when we were undergoing this model change, we were hiring salespeople, going into new geos. We were changing quotas when we moved from perpetual to subscription. Historically, the company was focused, the quotas were based on total contract value. I wanted to move them to annual contract value. We changed comp plans. I wanted more remuneration on subscription to drive the recurring revenue and less the compensation on perpetual. So we're going into new markets. We were hiring reps, setting new quotas, looking at compensation. And to me, we wanted to make sure we had all the unit economics kind of dialed in and right. So there's an old saying that you have to hit it straight before you hit it long. I wanted to make sure that we were hitting the ball straight before we went out and scaled the company, and we had the right business model and the right unit economics. So that is a group that we built over the past 4 years, and that was one of the first groups that I created when I started. In the next area that I turn to is tax, and that doesn't usually come top of mind. So you may ask, so why tax? Keep in mind, we were building a global sales distribution capability, entering new geos and markets, but our tax structure wasn't conducive for it. At the time, all of our foreign subs rolled up to our U.S. The U.S. entity, and the income in those foreign jurisdictions were taxed at the U.S. tax rate, which is one of the highest tax rates in the world. So we went off and created an Irish holding company structure, which gave us access to a new labor market and created obviously some very favorable tax consequences. And the Irish effective tax rate is much lower than the U.S. We also eventually migrated IP offshore and entered into cost sharing arrangements. So tax, it may not seem like it's top of mind, but if you're going to grow and scale the company and go into new markets, you have to have the right tax structure. So we hired a head of tax and created a tax function. So now, with the investments and sales that we were making, and the expansion and our distribution capability, we looked at tax, and the next thing that came to mind was legal. We had a legal team, a very capable legal team, and we were closing deals, but we knew that the business was going to become a little more complex, and everything from labor laws to governance and other potential issues. So that resulted in us hiring a general counsel. So a GC and an expansion in the tax function came hand in hand with the creation of a with the legal function. So all of this, as we built that FP&A, as we created the tax function, expanded the legal function, we kind of, after those things were well underway and the company was growing, it was pretty apparent that the growth was starting to accelerate. We're starting to see some pretty clear paybacks on the investments that we're making in the business. And one of the last areas I turned to was really the core accounting group, and we wanted to make sure that we had to add key personnel to handle a little more, some of the sophistication and some of the technical accounting matters that were coming our way. So we hired a VP of Finance and Accounting, Director of Financial Reporting. Eventually, to coincide with the IPO, we hired a VP of Investor Relations during the registration process. More recently, we hired internal audit. So hopefully that gives you a little flavor of how the finance function has evolved here at Tenable and has helped support our growth.
Yeah, that was very helpful. I'm curious, just to kind of take it back to 2014, when you joined, was the goal, IPO, that's what we're doing, or was it IPO and we're open to other exit opportunities if they come around?
Yeah, that's a good question. When I started in 2014, the security space was red hot. Market multiples were very high, and we thought we had the scale and even the growth, even though the growth was a little lower than what it is today. But we thought we had the growth and scale that would make us attractive to public investors. So keep in mind, we had 3 founders that had been running the company for some time, really owned most of the stock. And we said we did see an IPO in our future. As we began making those changes, even though growth rate contracted, because it does when you move to the subscription model, get lower ASPs, you're disrupting the sales funnel. We knew that growth was on the come and there'd be more growth. We went out and we made a conscious decision to, we wanted to go out and do a Series B round. And my job as CFO was to provide a measure of liquidity for the founders and potentially expand the cap table to add another top tier investor. We thought at the time in 2014 that would be a crossover investor like a T. Rowe, a Fidelity, or Wellington, who would step up, make an investment in the company in the way of common stock, and that would be a means to pre-sell a book, the IPO. But as we were going through this change, the security market started to cool, multiples started to contract. We were running this process, and like any good process, it not only targeted crossover investors, but late stage, top tier growth investors. And Insight quickly distinguished themselves with their persistence. And that all culminated in a very sizable round, Series B round, for $230 million. Insight was the lead. Excel participated as well. And again, that was 100% secondary, so no proceeds to the company. But that investment caused us to kind of rethink the IPO timeline. And eventually, the IPO happened in 2018, but we thought it would be, we thought it would be sooner. And then after the round, we thought it would be much later, like a 2019 or 2020, but it came sooner than we thought.
Okay, got it. Very helpful. And just wanted to harken back your comments about tax reminded me of some of the nightmares we had at Cornerstone. That was, we had hired a GC actually very early on, around the 40 or 50 employee mark, which I think is out of the norm for most SaaS companies. But the GC was so entrenched in the sales side of it. He was always looking at contracts and really helping with sales. Tax ended up becoming a big blind spot for us. And we hired our tax guy about 6 months before the actual IPO. And when he got in here, he started doing an assessment of taxes owed by state. All of a sudden, that blew up into a much bigger project and did cause some headaches during the S1 process. And we ended up getting an SEC comment around that. And so that advice around tax, I totally agree. It's an underappreciated part of the department and something that is better to get in order sooner rather than later. And one more story about the team. I know the bullet here, if we look underneath, it says you'll need 2, and the first bullet is hire for IPO experience or staff willing to learn quickly. Having IPO experience is definitely great. There's a ton of value to that. Steve, you've learned from doing this before. And at Cornerstone, our CFO very much thought, hey, I want to hire a bunch of people who have experienced the IPO. And so what he did was he went out and hired all Big 4 auditors. So the first tranche of hiring that he did Was he had about 5 people on his team. None of them were really qualified to go through an IPO when they made the decision to go public. So the move was to expand the team, and then all of a sudden, just 7 Big Four CPAs with IPO experience were all hired into this group. The thinking is, we have a lot of experience around the table. This is going to go smoother, which the knowledge definitely helps to an extent. But what ended up happening was, from a culture perspective, that's not the right mix of people to bring in. When you're bringing in people from that type of world, they're expecting promotions every year, and it caused a lot of headbutting and cultural issues with kind of jockeying for promotions. And so, just one word of caution is not hiring all groups of people who are going to be expected to get promoted every year. You want to really specialize and start doing that specialization as early as possible.
Completely agree.
All right, so up next, we're going to talk about speed and accuracy. So Steve, from your perspective as the CFO, the close is a little bit removed from you, but what is important about the close process at a public company?
Yeah, and my answer here may surprise a lot of people. I know a lot of CFOs would view the close as something that's tactical. I take a keen interest in it. I'm not saying I'm closing the books as the CFO. That would be, an overstatement. But the close is important to me as a CFO for a couple of reasons. Number one, it impacts your ability to, if you're a public company, market the stock, your ability to speak with investors, and it impacts the time in which employees can actively trade the stock in an open market. And just let me explain a little bit. As a public company, you have a quiet period. Quiet means that you're restricted from speaking with the street, communicating with investors, and employees consequently also cannot trade the stock during that restricted period. The quiet period for most public companies, it can vary, but a lot of companies are 2 weeks prior to the close of a quarter, up until 2 days after the announcement of earnings. So Tenable is one of the first mid-cap software companies to report earnings. That was by design. We want to be among the first to announce earnings, so we could create the narrative in the market. We do have public competitors, and we wanted to be able to control that narrative first. We wanted the window to be able to open up so employees could potentially trade stock. We wanted to be able to communicate with investors. And why the close is important, because the longer it takes you to close, the longer it will take you to announce earnings. More time you're subject to blackout, the less time you're communicating with investors, and the shorter amount of time in which employees and others can trade the stock. So the close process is pretty important. Also, whether you're a public company or private, if you are growing, you are evolving and expanding the board, changing the configuration, probably adding subcommittees like us. So we have an audit committee, and we were interviewing prospective audit committee members, even an audit committee chair. One of the first questions you get is, how long does it take you to close your books? And your answer, depending on your answer, there's a judgment there. The shorter time it takes you to close, the more favorably that's viewed, and the longer, sometimes that's a head scratcher and tough for board members and audit committee members to digest.
So that all the reasons for a fast close that you just gave are very big and broad examples, and a couple of them I actually haven't heard before, so that's fascinating. So you were able to take the close, which is traditionally viewed as a fairly boring and just necessary process. You turned it into a competitive advantage by reporting faster than everyone. That is enabling marketing to control the messaging and really hold that narrative. You used it to also increase employee happiness because they're able to sell their stock more for a larger period during the year. And then, let's see, what was the last point there? I'm blanking out on it now. But last but not least, it's communication, but also helping you recruit really quality audit committee members, right? Like that's all of a sudden a recruiting advantage for you.
Correct. I mean, they don't know how. I mean, sometimes they're new to the company. They don't see all the sausage making and what it takes to close. But the quicker you are, the more favorable disposition that is. And the other thing too is, we're trying to get information in the hands of people that need it. So we want to do that near real time. And we have people who own certain aspects of the budget and they're accountable for it. So it's more timely information in the hands of the decision makers.
That's awesome. So on that note, to take it to go back to 2014, what did the close look like when you joined, and then fast forward to today, and what does it look like?
Sure. Well, When we started, again, the group was of more modest size. We were doing soft closes for the quarters and even the months, and there's just really this focus to do a hard close really at year end, which is probably it's the right motion for the company. And so with
totally agree, by the way.
Yeah, and so if you're trying to grow, you're probably investing more on sales, and keep in mind wasn't an FP&A function here, so it was softer closes. The good news is the company had good systems, but there was a lot of disparate systems. NetSuite was implemented in 2014. There's an HRIS system. There was also Salesforce that was recently implemented. None of those really talk to each other. And the close process also included some pretty manual and complex calculations in Excel, which is what you would expect. Everything from stock-based comp to multiple element allocations for revenue, commissions, things of that sort. So if you look at where we are today, I talked about the importance of the close. Today, it takes us 10 calendar days for full financial statements. And that's with revenue and deferred revenue closed on day one, because that's really important to us. By the way, if you're a subscription-based company, the focus of investors often moves from the P&L and revenue to the balance sheet and deferred revenue. Because if you take the change in DR, deferred revenue, and add it to revenue, that is a good proxy of what you sold. So I know that revenue and more important, just as important, deferred revenue would be important. So we feel like we have that dialed in with a lot of our systems today. A lot of these are all integrated using MuleSoft to connect a lot of these systems. We have a BI tool in Tableau and Adaptive and others. So it's a little different. More importantly, and Mike knows, I'm a big fan of FloQast, and FloQast has really helped us formalize this monthly close process with evidence of work paper review, real-time close progress, and reporting, and provide close process documentation. So it added a lot of formality and rigidity to an important process to the company.
Awesome. That sounds great. So I just want to take a step back and recall. So Salesforce had just been implemented in 2014. Did I hear that correctly?
It was, I think, yes. I think maybe about 12 months prior.
Okay. Was there a CRM before that?
No, there was not.
Wow. So 80 million of revenue with no CRM is very impressive. That's pretty shocking.
Yeah, there was also, in terms of leadership, it was, if you were to talk to the head of sales at the time and you wanted to discuss pipeline, he would break out his yellow pad of paper and you talk about all the deals that he was expecting to close. So again, just a different process.
Okay, yes, that describes a lot. All right, let's kick over to documents now. So I mentioned during the intro, documents might seem mundane, but become very, very important when it's time for due diligence. So Steve, why is it important to have everything in one place from a business perspective, and then also from an exit perspective?
Sure. Well, if you're a company contemplating an IPO, sale, or partnership, or whatever it is, an important transaction, you need all of your information really in one place at your fingertips. You don't have time to go out and recreate schedules and reconciliations, or even find them on shared drives or in someone's PC, which is what often happens. And so the biggest thing that usually kills a deal is time. So time's really important here. And just to kind of put matters in perspective in terms of how important it is, if you go back to what I was talking about, which is the IPO. So Tenable went public in July of 2018. Now, we priced the deal July 25th. So the stock began trading July 26th. Had we done that 1 week later, we would not probably have gone public, and I'm not sure we would be a public company today. So keep in mind, if you just understand kind of the seasonal flows of the street, August is a very slow month for Wall Street. Kind of no deals don't get done, companies don't get public, people are on holiday and vacation. And when we went public in July 25th, we actually thought at the onset of this process, in terms of going public, we had our bake-off in March, And when we baked off in March, I sent out proposals to the banks, to all of our lead underwriters, inviting them to the bake off. It specifically said that we are contemplating a November IPO. And so we wanted proposals, that were kind of conducive to that timeline and get valuation, to get expectations on a lot of things. So it became clear what we were going through this bake-off. New equity issue market was stronger than we thought. Market multiples were very attractive. Companies were pricing with maybe on smaller scale with similar growth, with some pretty significant multiples. And after the bake-off, it became very clear that our IPO was not going to be in November, but the board looked at me and our general counsel and said, what does it take? Can we get to July? And so that timeline that we had well thought out and we had delivered and we were, and talking to the board about, all turned upside down. We had to go squeeze a couple of months out of the process. Keep in mind, we had $50 million of cash when I started. We had about $20 million of cash up until the IPO. And we had a very modest cash burn though. And so we knew that it had to be July. And if it wasn't July, there's a chance it could get into September and even October. And on the day we priced, Facebook, there's concerns about privacy. It was the single biggest point drop for a stock in the history of the stock market. There were signs the market was starting to cool, multiples were coming down, and after that, the IPO market today, I think it's fair to say, is a little different now than it was back, a few months ago. So timing's key, and having all your information in one place allowed us to quickly get through the process. According to Morgan Stanley, we are the quickest company ever, from filing an S1 to pricing an IPO. We filed the S1 April 27th, and that's the first S1, and we cleared comments, and we priced the IPO July 25th. That's about 90 days, and according to Morgan Stanley, that's record time. That's why time matters, and getting through diligence is important.
That's an amazing story. Yeah, just going into a board meeting and saying, hey, you get 5 fewer months to get ready for this must have been a pretty tough meeting, but then you guys made it happen. For context, at Cornerstone, for us it was north of 6 months before we filed our first S1 to when we actually went out. And we do have another thought here is, as you scale up as a company, there comes a time when you need to start really formalizing policies, procedures, and start drafting up those memos. When did your team start doing that, or were detailed documents like that in place when you already joined?
We were doing that. We were trying to be proactive about the process and get ahead of the power curve. So even though we were thinking November IPO, we knew there was a bake-off coming in Q1. So we were trying to get ahead of that curve. The long pole in the tent for us was 606, right? We were under 605 at the prior to the IPO. We knew 606 would be potentially the single biggest gating factor in determining the timing of an IPO. So we started doing that in 2017. Well, it corresponded with the hiring of a head of finance and accounting, the director of financial reporting. Those were that work. A lot of that work and that heavy lifting began in 2017, and we thought we were way ahead of the curve, that we would have maybe a year and a half or 2 years. But it turns out a lot of that preparation, early planning, the documentation, while I thought it was early, was probably just in time, and it could have been even sooner.
Yeah, I can certainly tell you were early relative to the rest of the accounting industry, if that makes you feel any better about that.
Thank you.
All right. Any other thoughts on documents and impact on due diligence before we move to the next section? All right, I'm gonna move on then. Next up is really talking about reconciliations here and utilizing technology to your advantage. So there's a research paper by a firm by the name of Ventana Research. They ran some surveys here and found that close to 60% of companies that are automating their reconciliation process, they're able to close the books within 6 days. And that's compared to 27%, only 27% who are closing their books in 6 days are doing that manually. So Steve, want to get your thoughts here. How are you leveraging automation on your finance and accounting team, both with reconciliations and more broadly than that?
Yes. And so I actually have a question for you, Mike, as I'm looking at this. we're 10 days close. I'm just more curious. We're 10 calendar days. So that tends to be probably 6 business days. Is this 6 calendar days, 6 business days?
This would be business days. Not everyone is as cutthroat as you, getting that calendar deadline date required. But a lot of private companies, right? They think about this on a business day basis rather than calendar days, since their reporting deadlines aren't quite as tight. So no, you guys would certainly fall into this camp.
Okay, that's good to know. But even if not, then we can. Every company can do better. Including Tenable.
There's always room for improvement, right? Yep.
Exactly.
Never ending process improvement.
So Mike, and so your question in that regard on the system side would be?
Yeah, just how are you leveraging different pieces of automation and technology to help with? I know we're chatting about reconciliations on this slide, but I'm curious with broader needs within the finance and accounting function.
Sure. Well, first, I'm going to start with on the sales side, because if you're a growth company, there's a lot of focus on sales. I know we spent some time talking about the close process. So with us, keep in mind adding a lot of sales capacity, going into new markets, adding new employees. It was important for us really to measure our progress in near real time on the sales side. So we deployed Tableau as our BI tool, as our data visualization platform, in coordination with sales ops, and that helped us evaluate unit economics such as quota to OTE, LTV to CAC. Matter of fact, Insight, I'm a big fan of this, but Insight has a periodic table of SaaS metrics. So if you haven't seen that, I would suggest you go to their website and take a look at it. But we talked about hitting the ball straight before you hit it long, making sure that you're successfully scaling the sales organization with the right unit economics, right quotas, all that stuff, right linear funnel. So we wanted to measure that in near real time. So Tableau is our platform and gives us a great data visualization on it. It helps us monitor and measure a lot of those important SaaS metrics. The other thing that's important to us, whether you're private or public, is that we wanted to make sure that we hit plans and we achieve our goals. So it also helps us land the plane for the quarter and near real time with regard to bookings and billings and revenue. For the street, we disclose calculated current billings, which is the change in current portion of deferred revenue added to revenue. Internally, we run the company on ACV bookings. Calculated current billings is a great proxy of bookings. And of course, we want to know revenue. So at the end of a quarter, I'm typically sending out an email to the board that morning, and I'm discussing performance to plan. And I'm also telling them where revenue is and what our bookings is and calculated current billings. So that information is really important, and that all happens with the integration of all these systems. And the other thing too is that I mentioned we wanted to build more interoperability between these disparate systems. So now we are connecting NetSuite with Salesforce. We have a data warehouse in Azure that pulls all this data together. It also pulls information from Exactly, which we use for sales commission calculations. Within NetSuite, we have adopted 606, as I mentioned, but there's advanced revenue recognition management for these multi-element arrangements. So all this really comes together in a way that provides some pretty meaningful insight. So BPM, business process management, is really important to the company.
And I definitely, despite being an accountant, love the sales operations and sales efficiency side of the shop. Just out of curiosity, what are the top maybe 2 or 3 sales metrics that you really focus on?
Okay, so here's my view of this: is that when you're investing in a company, if you're going to have a cash burn or even some losses, sometimes it's hard for board members or investors to see if it's working. So I think you should talk about a couple of key things. Number one, what's the achievement rate on quotas? So if you have a sales rep that carries a $2 million quota, we measure achievement to that. So if you have a 90% achievement on a $2 million quota, you're getting $1.8 million return. And I like to see that realized return on the quota be at least 4 times higher than the OTE of the sales rep. So OTE is the total commission that the total cash compensation we pay a sales rep. And if you look at the quota, that should be 4 times or more higher, and we measure achievement against the quota to tell us if it's working. So first and foremost is productivity of the sales team. by looking at quotas to OTE, achievement rates on the assigned quota, and then the participation rate, which is how many reps are actually above quota or below quota. So that's sales rep productivity. Then on the customer side is unit economics, LTV to CAC. We measure payback on a new dollar invested. For us, it's 12 months. We measure the lifetime value of that customer. We keep a customer an average 7 years, and our LTV to CAC is close to 8x. So sales rep productivity and unit economics on the sales upside, I think, are the two pillars.
Yeah, that CAC payback period, so 12 is an excellent number, 12 months. I'm curious, did that number creep up ahead of the IPO? Meaning were you investing more heavily in sales than you generally do, or has it been pretty consistent at that number of 12?
It's been somewhat consistent. And the reason why is because we have a product. A lot of people, they know Tenable, but there's a product that we sell. It's called Nessus. It's one of the most ubiquitous and beloved security products in the market today. It's been downloaded over 2 million times. There's only estimated 2 million security professionals in the world. And so while it's a free product, it seeds the market and creates an on-ramp into our paid products. And a third of all of our enterprise sales come from Nessus. So for us, the CAC hasn't changed because we're able to have some pull-through from that free or even paid Nessus product into a larger platform sale. And that's one of the reasons why we have some of the compelling economics.
Okay, we're definitely going off script here, but I'm curious what percentage of your leads are coming from that free product?
Yeah, well, we don't necessarily disclose the percentage of leads, but what we will say, if you think about the company as a whole, we have over 24,000 customers. 20,000 paying customers are Nessus customers, paying Nessus customers. It's a $2,000 to $5,000 recurring subscription sale. So it's 25% of our business. So 75% of our business is the paid enterprise platform. And by the way, we also have a free product that's not in this. So 75% is paid enterprise. A third of all of that paid enterprise was once a Nessus customer, a paid Nessus customer, or even a free Nessus customer. So a third of all of our enterprise sales really are from existing users or customers.
Wow, that's a great model you all have in place over there. Good stuff.
Thank you.
Another notion here is, as you're going to go public, clearly controls and SOX compliance starts to come into play. So have you used any solutions for really enforcing best practices on the SOX control front?
We went public, and I think what the test is, if you have, and we floated 10% of the company in connection with the IPO. I think for SOX, if you have less than 700 million in public float, you're considered an EGC, which is an emerging growth company and not subject to the requirement of SOX. We have a lockup that expires at some point. There's going to be more shares in the hands of public investors. So although we're still technically an EGC, we are anticipating that we will need to be SOX compliant really by the end of this year, the end of 2019. So that resulted in us hiring a head of internal audit. And some of the software that we're looking at right now is more on the GRC side, which is the governance side. And so for us, we're still building out that function and still building out and automating some of that, but it's a new motion for the company.
Okay, so to harken back to one of your own statements, you want to hit it straight before you hit it long with internal audit.
That's correct, and we're also we're probably going to wind up using FloQast, as evidence and review of a lot of these important controls that we need for SOX.
Awesome. Well, love to hear that. And I will tell you, unfortunately, I can hit the ball very long, but not very straight. So I have, on the course at least, fallen into that trap and can't make it happen.
It sounds like a lot of us, Mike.
Great. Well, that wraps up our question section here. I did want to kick to the last slide here and just make everyone aware that if you head over to flowcast.com/resources, we do have a definitive guide to effective close management here. This is really great for any company who's looking to optimize their close, of course, but also if you're about ready to scale and this is becoming more top of mind for you, certainly recommend checking this out. So please feel free to head over to our website to go through that. And with that, I wanted to open up the floor to any questions that we might have. And Christina, did you want to hop back in and help us out with this?
Yeah, happy